China just launched a new gold system, and within hours, trading desks from Hong Kong to London went quiet. Not because nothing happened, but because everyone was trying to understand what just did. For 80 years, the dollar has sat at the center of global trade, untouchable, unquestioned, assumed permanent. That assumption just cracked. Somewhere in Hong Kong, a settlement platform went live. Quietly, deliberately, backed by some of the largest banks on earth, and it was built to do one thing: move gold without the dollar in the room. If this system works the way it's designed to work, the next decade of global finance will not look like the last one. And by the end of this video, you will understand exactly why. Stay with this one until the very end, because what happens next could determine how your savings, your investments, and your future purchasing power are affected. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one purpose: to help serious, wealth-conscious viewers understand the strategic economic shifts unfolding beneath the surface of daily headlines. Before those shifts become common knowledge, this is not entertainment. This is a briefing. Before we continue, take a moment and let us know in the comments where you're watching from today. This audience spans nearly every continent, and it is always worth seeing just how far this conversation reaches. And if you find value in this kind of analysis, and the kind that respects your time and your intelligence, consider joining the small but growing community who subscribe to this channel, not for hype, not for noise, but for clarity, delivered the way a serious topic like this deserves. On a quiet morning in Hong Kong, something changed. It did not arrive with sirens or breaking news alerts. It arrived through a simple government announcement, the kind that most people scroll past without a second thought. But for those who study money, power, and the slow shifting of global control, this was not a small story. This was a signal. Hong Kong's government confirmed that a new gold trading, settlement, and clearing platform had officially begun operating. On the surface, it sounded technical. Bankers would call it infrastructure. Analysts would call it market plumbing. But strip away the jargon and the meaning becomes clear. A new system now exists to move gold around the world, and it was built to work without leaning on the US dollar. For most of modern history, that idea would have sounded strange, almost impossible. The dollar has been the quiet backbone of global trade for nearly 80 years. It is the currency oil is priced in. It is the currency central banks hold in reserve. It is the currency that nations trust, not because they love it, but because they have never truly had another practical choice. Gold, on the other hand, is older than any currency. It does not answer to a government. It does not get printed. It does not lose value because a central bank decided to create more of it overnight. For thousands of years, gold has represented something simple and powerful: trust that cannot be manufactured. Now, for the first time in a serious, coordinated way, a major financial hub in Asia has built a system that connects gold trading directly to a currency other than the dollar. And it did not do this quietly by accident. It did this deliberately, with the backing of major global banks. This is where the story becomes important for everyday investors, business owners, and professionals watching from outside the world of high finance. Most people assume that changes like this happen far away, in boardrooms and government buildings, and that they have nothing to do with personal savings or retirement accounts. That assumption has always been wrong, and it becomes more wrong every year. Money systems do not change overnight. They change slowly, one small brick at a time, until one day people look up and realize the entire structure has shifted beneath them. Historians who study currency collapses and monetary resets describe the same pattern again and again. First comes a new payment system, then comes new trade agreements, then comes reduced demand for the old dominant currency. And by the time most people notice, the shift has already happened. This is why serious observers are paying close attention to what took place in Hong Kong. It was not simply a new trading desk opening for business. It was a message sent to the rest of the world, a message that says an alternative now exists, and it is ready to be used. The location itself matters. Hong Kong has long served as a bridge between East and West, a financial center trusted by both sides. By choosing the city to launch a system built around gold and non-dollar settlement, the message becomes even harder to ignore. This was not built in isolation, it was built to connect. And connection is exactly the point. This new platform does not exist on its own. It links directly into a much larger financial network, one centered in mainland China, with access to enormous demand for physical gold. That connection is where the real story begins to take shape. And it raises a question every wealth-conscious viewer should be asking right now. If gold can now move through the world using a path that avoids the dollar entirely, what does that mean for the currency millions of people still trust without? To understand why this new platform matters, it helps to look past the headlines and into the actual mechanics of how gold moves through the global financial system. Most people picture gold trading as something physical: bars being loaded onto trucks, vaults opening and closing, metal changing hands. In reality, most of the gold market does not work that way at all. For decades, the London market has operated on what is called an unallocated system. This means that when banks and institutions trade gold, they are usually trading ownership rights, not physical metal. The gold sits in a vault, and paper claims to that gold move between parties. Only a small percentage of trades ever result in actual bars being physically shipped anywhere. The system works because it is fast, efficient, and reduces the cost and risk of constantly moving heavy metal across borders. Hong Kong's new platform copies this same basic model, but with one critical difference. Instead of settling trades through the dollar-based infrastructure that London and New York rely on, it settles through a structure that connects directly into mainland China's financial system. This means gold can now be traded, cleared, and settled using a pathway that does not require the dollar to touch the transaction at any point. This is not a small technical detail, it is the entire purpose of the system. The platform links directly to the Shanghai Gold Exchange, which gives it immediate access to one of the largest pools of physical gold demand on the planet. Asia has been the world's leading consumer of physical gold for generations, driven by culture, tradition, and a deep historical trust in the metal. Yet, despite this massive demand, gold prices have traditionally been set in Western markets, far from where most of the actual buying happens. This new system is designed to shift that balance, giving Asian markets a stronger voice in determining the price of gold during their own trading hours. What makes this launch even more significant is who agreed to participate. This platform did not start with small, unknown players testing an experimental idea. It began with a coalition of major global banks, well-known names trusted by institutions around the world, alongside mining companies and refineries responsible for supplying real physical gold. When institutions of this size choose to build shared infrastructure together, it signals something deeper than convenience. It signals confidence that this system is meant to last. There's also a physical side to this story that deserves attention. In the lead-up to the launch, several participating banks began importing large gold bars into Hong Kong, the same standardized size long used in the London market. This was not random. It was preparation, a way of building up reserves ahead of time to support the new system once it became fully active. Authorities have also announced plans to significantly expand gold storage capacity in Hong Kong over the next few years, aiming for a level that would rival the reserves held by many entire nations. One major bank alone has already committed to expanding its custody capacity to handle far more gold than it currently holds. These are not the actions of a system meant to remain small or symbolic. These are the actions of a system built with long-term ambition. So the question becomes, is this simply new infrastructure, a more efficient way to move gold around Asia? Or is it something more, a quiet but deliberate step toward reducing dependence on the financial system the world has relied on for the better part of a century? The honest answer is that it is both. Infrastructure and intention are rarely separate. Every major shift in financial history has started the same way, with new tools being built quietly, tested carefully, and scaled gradually, long before the wider public understands what is happening. And this is precisely where the story deepens, because this platform does not exist in isolation. It is only one piece of a much larger pattern that has been building for years, a pattern that touches currency reserves, trade agreements, and the slow, steady erosion of a system many still assume is permanent. To understand why one settlement platform in Hong Kong matters, it helps to zoom out. This is not an isolated event. It is one thread in a much larger pattern that has been forming quietly for years, a pattern that rarely makes front-page news because no single moment feels dramatic enough on its own. De-dollarization is not a single event. It does not arrive with an announcement or a deadline. It builds slowly through hundreds of small decisions made by central banks, governments, and trading partners across the world. A new payment agreement here, a currency swap arrangement there, a reduction in reserve holdings that goes unnoticed by most of the public. None of these actions alone would make headlines, but together, over years, they form a direction. And that direction has been consistent. For much of the last 2 decades, central banks around the world have been quietly increasing their gold reserves while reducing their reliance on the US dollar as the primary reserve asset. This trend accelerated noticeably after periods of geopolitical tension when nations became more aware of the risks that come with depending too heavily on a currency controlled by another government. Sanctions, asset freezes, and shifting alliances all served as reminders that a reserve currency can also become a point of vulnerability. Yuan-denominated settlement systems, like the one now operating in Hong Kong, offer countries a practical alternative. For a nation exporting goods to China, or holding yuan reserves through trade, having a direct path to convert that currency into physical gold is significant. It means less dependence on dollar-based banking infrastructure to complete a transaction. It means fewer intermediaries, fewer points of friction, and fewer opportunities for outside interference in a trade relationship between two other nations. This is the quiet appeal of the new system. It does not attack the dollar directly. It does not need to. It simply offers an alternative path, and over time, alternatives tend to get used. This is also why serious observers are cautious about describing de-dollarization as a sudden event. History rarely works that way. Currency shifts of this size tend to unfold over years, sometimes decades, not overnight. The dollar remains deeply embedded in global trade, and that position will not disappear quickly. But gradual change carries its own kind of danger, precisely because it does not feel urgent in the moment. A slow erosion is easy to dismiss. Each individual step looks small enough to ignore. A new settlement platform here, a currency agreement there, a modest increase in gold reserves reported in a quarterly filing. None of these events feel significant enough on their own to change anyone's financial decisions. Yet historians who study monetary transitions point out that this is exactly how past shifts in global currency dominance have unfolded. The old system did not collapse in a single moment. It simply lost relevance, piece by piece, until the world had already moved on. This is the pattern now forming around the dollar, and Hong Kong's new gold system fits neatly into it. It does not need to replace the dollar to matter. It only needs to reduce reliance on it, one transaction at a time, one institution at a time, one trade relationship at a time. For Western investors and business professionals, this creates a particular kind of risk, the risk of complacency. It is easy to look at the dollar's continued dominance today and assume that dominance is permanent. It is easy to see gradual change and conclude that gradual means unimportant. But every major shift in monetary history looked gradual, right up until it didn't. This is not a call to panic. It is a call to pay attention. The systems being built today, quietly and deliberately, are the systems that will shape the financial environment of the next decade. Understanding them early is not about fear. It is about strategic awareness, the same kind of awareness that has always separated prepared investors from those caught off guard. And this raises the next essential question, the one that matters most to anyone managing real wealth. What does a more diversified, gold-backed, multipolar financial system actually mean for the individual investor, the entrepreneur, and the family trying to protect what they have built? Up to this point, the story has focused on banks, governments, and global trading systems. But for the professional, the entrepreneur, and the individual quietly building wealth, the real question is simpler and far more personal. What does any of this actually mean for their own money? The answer begins with understanding what gold has always represented throughout history. It is not simply a commodity that rises and falls in price on a screen. It is, and has always been, a form of protection. When currencies lose value through inflation, when governments print more money to cover their debts, when trust in a financial system weakens, gold tends to hold its ground. It does not rely on a promise from any single government. It does not depend on the policies of one central bank. That independence is exactly why it has survived as a store of value for thousands of years, while countless currencies have risen and eventually disappeared. Now consider what happens when a new, well-funded system emerges that gives Asian markets a stronger role in determining how gold is priced. For decades, gold prices have largely been set in Western trading hours, even though Asia has consistently represented the largest source of physical demand. That imbalance is now being challenged. As pricing power shifts to include a larger Asian influence, the entire structure of global gold markets begins to change. This can affect volatility, trading patterns, and how quickly prices respond to global events. For professional managing investments, this is not a minor detail. It is a shift in the very foundation of how a major asset class is valued. There is also a broader lesson here about the risks tied to depending on a single financial system. For most of modern history, dollar-based structures have felt permanent, almost invisible in their dominance, but permanence is often mistaken for certainty. History shows that financial systems evolve, sometimes slowly, sometimes quickly, and those who prepare early are the ones who navigate change with the least disruption to their own wealth. This is where the professional and entrepreneurial audience should pay closest attention. Building wealth is rarely just about earning more. It is about protecting what has already been built. A business owner who spends years growing a company understands the value of stability. An investor who has spent decades building a portfolio understands the importance of not letting a single point of failure put everything at risk. Diversification is not a trend or a talking point. It is a discipline, one that applies just as much to currency exposure as it does to any other part of a financial strategy. None of this requires panic or dramatic action. It requires clear thinking. A system like the one launched in Hong Kong does not mean the dollar disappears tomorrow. It means the world is quietly building alternatives, and those alternatives are becoming more credible with each passing year. For a wealth-conscious individual, the appropriate response is not fear. It is awareness, patience, and a willingness to understand how the global financial landscape is shifting beneath the surface. Those who study monetary history often repeat the same lesson. The individuals who protected their wealth most effectively during past transitions were rarely the ones who reacted at the last moment. They were the ones who paid attention early, who understood the direction of change long before it became common knowledge, and who made calm, informed decisions rather than emotional ones. This is the moment for that same kind of attention. The systems being built today in Hong Kong, in Shanghai, and in financial centers around the world are not distant abstractions. They are the early architecture of the next chapter in global finance, and understanding that architecture now is the difference between being caught off guard later and being prepared.